If you just glance at the Indian stock market, it doesn't look like a catastrophe. The Sensex and Nifty are only a few percent off their recent highs. It's not in free fall, and the big sector moves are hidden inside an index that looks almost flat. Zoom out globally and you see a similar pattern. The S&P 500 is also just a few percent below its recent peaks after several weeks of choppy trading. Investors are still fixated on interest rates, inflation and AI narratives, and the market pricing largely reflects a view that the Middle East war is a contained temporary shock that will eventually be managed. But if you're in India, where close to 4/5 of our crude and a significant share of our gas needs are met through imports, you cannot afford to shrug this off just yet. We are living through one of the largest physical energy disruptions the world has ever seen. Some measures the biggest shock to global oil and gas flows in history. In fact, this 2026 shock is on some metrics larger than what we saw after Russia invaded Ukraine. And the scariest part is that this isn't a logistical delay of a few weeks or months. This is the permanent physical destruction of infrastructure that keeps the world running. Today, we'll decode what just broke in the global energy market, why countries like South Korea are already rationing fuel, how it affects the chips that run the entire AI boom, and most importantly, what this means for you, the Indian investor sitting thousands of miles away. To understand why this time is different, you have to understand the difference between delay and destruction. In the past, during the Gulf Wars or even the recent Russia-Ukraine conflict, the oil and gas was still there. The pipes were intact, the refineries worked. The problem was just getting the fuel from point A to point B. That is not what is happening today. A few days ago, Qatari-Iranian declared something called force majeure. Force majeure is nothing but a legal clause that basically means an act of God or war has happened and we are cancelling our contracts. They have now declared force majeure and cancelled long-term LNG contracts with buyers in China, Italy, South Korea and Belgium after Iranian strikes hit Qatar's Ras Laffan complex, the giant gas factory where Qatar turns gas into LNG and loads it onto ships. Those attacks have knocked out about 17% of Qatar's LNG export capacity, which is roughly 13 million tons a year. In energy terms, just for perspective, that is like removing the entire annual gas supply of a mid-sized country from the global market almost overnight. Well, the reaction was that within days, the Asian LNG spot prices jumped by around 60%, pushing benchmarks back toward multi-year highs as buyers scrambled to replace Qatari cargoes. Let's look at South Korea. It imports almost all its oil and is one of the world's biggest LNG buyers. Gas-fired plants generate around 27% of its electricity. So any shock to the LNG supply hits both the grid and the factories. Seoul has already rolled out fuel-saving measures, including a rotation system that keeps government vehicles off the road one day each week. The country whose chip makers supply a huge chunk of the world's memory chips is suddenly having to worry about keeping the power on. But there is a dark, almost unbelievable irony to how this is playing out. The facility that was hit in Qatar, Ras Laffan, sits on one side of the largest gas field in the world. The other side of that exact same geological rock belongs to Iran. It's called South Pars. Iran's side was struck first, then Qatar's side was hit in retaliation. So the molecules that become LNG for 4 continents and the feedstock for ammonia that feeds global agriculture all come out of the same rock. And now critical facilities on both sides of the rock have been affected. And here's what most people miss. Even if Qatar wanted to rebuild this tomorrow, it can't just order a few spare parts. The giant machines that feed LNG trains, especially the mega-scale air separation units, ASUs, typically take 3 to 4 years to build and install. And only a handful of specialized companies worldwide can supply them at that scale. So realistically, we're talking about the better part of half a decade before all of the capacity is back. Now let's talk about the cloud. Not the one in the sky, but the data center cloud that runs on chips. They also depend on this very rock. Qatar's Ras Laffan complex processes gas from North Field and in the process supplies 30% of the world's helium as a byproduct of its LNG operations. Helium is the invisible noble gas that helps cool and stabilize the lithography and other tools that print chips that are powering the AI boom. So when Ras Laffan went offline, it didn't just choke off oil and gas flows, it also choked off a third of global helium supply, putting direct pressure on the fabs and tools that train and run AI models. The energy shock and the AI hardware shock are not two separate things. They are a part of the same story, both constrained by the same choke point in the Gulf. Now you might be thinking, okay, Qatar cancelled contracts with China, South Korea. India wasn't on that list, so why should I care? Well, here's why you should care. India depends on imports for the vast majority of its crude oil, close to 9 barrels out of 10. And that dependency isn't going away anytime soon. Delhi has tried to reduce its exposure to the Strait of Hormuz, and today roughly 70% of our crude comes from outside that single choke point. But pricing is still driven by Middle East benchmarks and global spot markets. So when Asian LNG prices jump by 40-50% in a few days, those higher prices eventually bleed into what India pays at the margin. When energy gets that expensive, it behaves like a massive invisible tax on the whole economy. So think about the companies in your portfolio: cement, steel, chemicals, fertilizers. They burn huge amounts of fuel and power. If their energy costs spike, their margins get crushed. And it does not stop there. When India has to spend more money, more dollars to buy the same barrel of oil, the rupee usually weakens. A weaker rupee makes every import costlier and pushes inflation up. With inflation running high, the RBI has far less room to cut interest rates. And if rates stay higher for longer, the market will struggle to justify the kind of stretched valuations we've been seeing over the last 2 years. And if this still sounds exaggerated to you, consider this. On 24th March, right in the middle of this crisis, the Ministry of Petroleum and Natural Gas rushed out a new order under the Essential Commodities Act. It creates a clear, time-bound framework to fast-track gas and product pipelines by cutting through the local approvals, land hurdles and high fees. And in its own note, the government says that this is tied directly to the disruptions in the Strait of Hormuz and the damage to Gulf liquefaction plants. So when a government system moves this fast to rewrite the rules for core energy infrastructure, it's a clear signal that policymakers see the supply shock as real. And as investors, you should too. We are entering an era of structural scarcity. The market is currently sleepwalking. It is pricing in a temporary disruption when the physical reality is permanent destruction. As an investor, you need to look at your portfolio right now and ask yourself a hard question. How much of my wealth relies on the assumption that energy will stay cheap and abundant? Because the era of cheap, reliable energy just ended in a fireball over the Strait of Hormuz. This isn't about panicking, but it is about positioning. The smart money is already moving out of energy-heavy, low-margin businesses into sectors that can survive or even profit from a sustained energy deficit. I'm Yashodhara and you've been watching DeKoder. If this helped you see the blind spot in the market, hit the like button, share it with another investor and subscribe. Until next time, stay smart and stay informed.